Tyler, I am a Berkshire Hathaway shareholder. I have been for many, many years. It was one of the first stocks I ever bought. I'm really glad I did because my long term returns from it have been pretty solid. But it is a big company. Warren Buffett himself has said that the company will not produce the kind of returns it has in the past. The numbers have just gotten too large. So that makes me kind of want to look at companies that kind of take somewhat of a similar approach, but still have a lot more room to grow and are taking kind of a newer, like 21st century approach to building a conglomerate. Um, One of them is another insurance company called Markel. Markel there's three parts to the business. If you're not familiar, I'll give you the quick version. There's an insurance business. Mainly, they're focused on specialty insurance and reinsurance. Specialty insurance is things that normal insurance companies wouldn't touch. When I needed an umbrella policy to cover rental properties, it was underwritten by Markel. Just for as an example, for high risk businesses, they would go to Markel. They are a profitable underwriter. There's a lot of money to be made in specialty insurance if you're good at it, which they are. 94% combined ratio in the first quarter suggests that they made a nice profit on underwriting. They also have a stock portfolio, kind of like Berkshire Hathaway does. In fact, their top holding is Berkshire Hathaway. About 12% of Markel's stock portfolio is in Berkshire Hathaway. They own 136 stocks altogether, about an $8 billion stock portfolio. And last but certainly not least, before I take all of Tyler's talking points away from him, is Markel Ventures. They invest in kind of smaller companies that would move the needle for Berkshire Hathaway. Think like early stage startup companies that even if they were to like 10x in size, wouldn't really move the needle for Berkshire. But for a company like Markel with a sub $18 billion market cap, as opposed to Berkshire's $700 billion thereabouts, yeah, it's a different kind of approach that could actually produce some pretty big results over time. So, Tyler, I've talked for a little bit about it, but what are you loving about Markel these days? I know you mentioned a few things earlier.
Well, in that vein of, hey, why not look for something that's trying to replicate what Berkshire's doing? If you look at the port, like you were just saying, the ventures, like the portfolio of companies that it owns, if you go up and down it, it really rings an awful lot of things that you're like, yeah, that sounds like something that Berkshire Hathaway would own. A company that makes dredges for dredging, ports, companies that make home builders, large crawler cranes for heavy construction, a precast concrete manufacturer. I mean, you go up and down this and you're like, yeah, this really sounds exactly what you would expect to see right alongside something like See's Candies or a lot of the other things that are known to be in the Berkshire Hathaway portfolio. And over the past 10 years, it has put together a rather impressive run in terms of growing its book value, growing earnings, things like that. And in that same vein of Berkshire, you don't want to look at earnings at any given moment to value the stock because, like you said, it has a pretty sizable stock portfolio. And because of that, it has to value those every quarter. And if the stock values go down, it takes a hit out of earnings. So what really drew this to me, like brought Markel into focus lately, is the way that it's valued. We just did a video recently on, the valuation of Berkshire Hathaway at about 1.4 times book. Well, Markel right now is trading for about 1.3 times book, so it's a little bit cheaper. But when you start to consider some of the other things, that's where it really gets interesting. So about 36% of its market cap right now. Markel is a $17 billion company, give or take. 36% of its market cap is cash right now, based on the amount of cash that's on the books. And if you kind of even out its debt and cash, it's a net cash position. So there is a ton of cash sitting on the books, and it really feels like this is a company that's going to start pouncing on some new ideas with all of that. And at the same time, if we were saying earnings doesn't work, if you look at it on a free cash flow basis, this company is currently trading at 7 times free cash flow, which is extraordinarily cheap for a well-run business like Markel. So when we kind of combine all of these things together, it's one of those companies where, like, I've looked at Berkshire a lot. I think maybe it might be slowing down a little bit because of its size, and maybe the valuation isn't stupendous. I think Markel might be something people want to start really paying more attention to because there might be something, a little bit of meat on that bone, I guess you could say.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.